Americans are struggling to keep up. Grocery bills are up, gas prices are unpredictable, and mortgage rates feel like a mountain. And yet, the biggest driver of all this chaos sits quietly behind closed doors, the Federal Reserve. Today, we're diving deep into what the Fed is, what their recent decision means, how it affects you directly, and how a surprising Trump versus Powell twist could shake the entire US economy. Let's begin with a simple question. What is the Fed and why does it matter to you? The Federal Reserve, or simply the Fed, is the central bank of the United States. Its job is to manage inflation, control interest rates, and stabilize the financial system. Every few weeks, the Federal Open Market Committee, FOMC, meets in DC to decide one major thing: should interest rates go up, stay the same, or come down? Now, here's why that matters. Imagine you want to buy a home. If the Fed raises rates, the loan you need becomes more expensive. A 5% mortgage could become a 7% mortgage, costing you tens of thousands more over the life of the loan. Same for auto loans, same for your credit card APR, same for your student loans, your business loans, everything. So what did the Fed just decide? In their latest meeting, the Fed chose to hold interest rates steady at 5.25% to 5%, the highest level in over 2 decades. But here's the catch. They hinted that another hike may still come later this year if inflation doesn't cool down fast enough. Let that sink in. We're already at historically high rates and they're still keeping the option open to go even higher. So what does that mean for you? Let's break this down like real life. If you're renting, landlords often borrow money to buy property. Higher interest means higher mortgage costs, which they pass down to renters. So yes, rent hikes are tied to Fed decisions. If you're carrying credit card debt, the average credit card APR is now above 24%. That means if you're not paying your full balance, you're burning cash faster than ever. Trying to buy a house, mortgage rates recently crossed 7%. On a $400,000 loan, that's $9,000 more in yearly interest than at 3%. Running a small business, your lines of credit just got more expensive. Scaling your dream, harder. Surviving, riskier. Now let's bring in the big twist. Trump versus Powell. In a recent press release, sources suggest Trump, if re-elected, might replace Fed Chair Jerome Powell, who was ironically appointed during Trump's own term. Why? Because Powell's tight money policy is seen as stalling economic growth. Trump wants lower rates to stimulate business, boost the stock market, and drive faster GDP growth. But here's the thing. Cutting rates too soon could spike inflation again. Remember 2021, 2022? Supply chain crunches, stimulus checks, exploding housing prices. The Fed is terrified of repeating that mistake. So what's the Fed really scared of right now? Three words: sticky core inflation. While food and gas prices have eased a little, core inflation, things like rent, insurance, healthcare, remains stubbornly high. The Fed knows that if people think inflation is here to stay, it becomes a self-fulfilling prophecy. And yet, Americans are getting restless. Consumers are maxing out credit. Student loan payments are back. Small banks are failing. Layoffs are creeping into tech and retail again. The Fed's rate hikes are cooling the economy, but possibly too much. So what happens next? Let's break down the scenarios. Scenario 1, the Fed raises rates again. This would hit housing even harder. Auto loan rejections would increase. Credit defaults could rise. Markets may panic short term, but long-term inflation may finally drop closer to the 2% target. Scenario 2, the Fed holds steady for months. This gives businesses breathing room, but if inflation rises again, like after pandemic stimulus, the Fed could lose credibility. Scenario 3, the Fed starts cutting early. Stock markets would love it. Mortgage rates may drop, but inflation could surge again, and that might mean even higher rates down the road. Now, here's where it gets personal. How should you prepare starting today? Pay off high interest debt, especially credit card. Avoid variable rate loans. Lock in fixed interest if possible. Delay large purchases unless absolutely necessary. Invest cautiously. Use dollar cost averaging into index funds like VTI or SPI. Boost emergency savings. Aim for 4 to 6 months of expenses. Watch Fed meetings like your paycheck depends on it, because it does. Let's now talk about a deeper truth no one's telling you. For decades, Americans have been told the Fed will save us. Markets always bounce back. Just keep spending. But the real power isn't in the Fed. It's in how you manage your money during uncertain times. If you adapt, stay lean, and think ahead, you won't just survive, you'll grow. The average American is reacting. You're preparing. And remember, economic storms don't last forever, but how you sail through them determines your financial future. So, what's your plan? Because whether the Fed raises, holds, or cuts, one thing's certain: they'll make their move. Will you make yours?